MAS is not going around trying to find managers who are at fault and try and penalize them and punish them.
Just let me give you guys a quick rundown of the 4 key fund incentives that we have in Singapore.
I think one thing that the investment professionals looking to use this approach need to be aware of is that
Hello listeners, Singapore didn't become a financial hub by accident. It became a financial hub by design. Welcome to this live episode of the Asian Century podcast. Today we are diving into the regulatory and tax landscape for fund managers in Singapore. With insights brought to you today by a seasoned funds lawyer and also a leading tax advisor. Today's episode is brought to you by InCorp Singapore. And especially today, we have a co-host with me, Ying. You might remember her from a previous episode on geopolitics. She's the head of family office and fund services in InCorp Singapore. Ying, welcome.
Thanks, Bob.
So Ying, why is today's episode important?
We created these sessions for one purpose, which is to give overseas regulated fund manager, first-time fund manager or multi-family offices a clear and step-by-step playbook for them to set up fund platform in Singapore, which covers fund management entity and fund vehicles. Now, according to the survey conducted by Monetary Authority of Singapore, in short MAS, who is the regulator of the financial institution in Singapore, the asset managed in Singapore grew to 5.4 trillion Sing dollar in 2023, and more than 77% of that capital originates outside Singapore. And the number is expected to continue to rise as the Asia-based wealth continue to diversify. So there are 3 factors that position Singapore as a preferred financial hub for the fund manager to set up their platform. Firstly, the city is very much open for business. It offers a stable, transparent, and trusted environment and actively encourage fund managers to set up operation here. Secondly, it has an engaged regulator. MAS maintain high regulatory standard and also provide clear guidance through consultation paper, FAQ, guidelines, and direct industry dialogue. And lastly, there are attractive tax incentive schemes that support the growth of the industry. So I'm very excited about today's sessions because we have a guest from Reed Smith, Shawn, who is very experienced and very, very passionate about what he does. And Shawn will share a lot of insights and his observations on what makes the first-time fund manager succeed in the industry. So I hope the audience stay with us to the end because there are a lot of information to be unpacked today. We are breaking down the discussion into 2 parts. The first part is to get the fund managers ready. In these sessions, we will cover the regulatory framework for fund management activities in Singapore. We will touch on licensing requirement, if there is any exemption or alternative pathway available for the fund manager, and the tax incentive for the fund managers. We will then take a deep dive in second part into the fund structures. There are key questions that we encourage a fund manager to answer before structuring a fund. We will discuss the commonly used fund structure and the tax exemption available to maximize the investor's return. Back to you, Bob.
Thank you, Ying. Please note that this webinar does not constitute legal advice. And thank you for those watching us live. If you have any questions, please put it into the Q&A tab on Zoom. So as mentioned, we have 2 special guests with us. First, from InCorp Singapore, we have the tax advisory, Alan Sim, here with us. Alan, welcome.
Thanks, Bob.
And as mentioned already, we have the seasoned fund lawyer from Reed Smith LLP, Shawn Tan. Shawn, welcome.
Thank you, Bob. Thank you, Ying. Great to be here today. Just a quick introduction to the audience. I'm Shawn Tan, Investment Funds Counsel from Reed Smith. I am based in Singapore and deal with clients internationally. I've been doing this for more than a decade now, and I help fund manager clients with 3 buckets of work. So firstly, I help them with setting up their offices and ensuring their ongoing regulatory compliance. Secondly, I help fund managers with setting up their funds. And thirdly, I also help fund investors invest into funds. Reed Smith is a US headquartered law firm with offices globally and full Singapore law capabilities. In the fund space, we have experts in New York, in London, Paris, Dubai, Abu Dhabi, Hong Kong, and of course Singapore. Essentially the places where most fund management activities are centered.
So, Shawn, we receive a lot of inquiries from fund managers of different backgrounds, from different countries about setting up their operations in Singapore. So for today's discussions, I'm going to create 2 scenarios to make the discussion real. So scenario number 1 is a Hong Kong regulated fund manager by the name of Amazing Co Limited, who is looking to expand and market to accredited investors who are moving funds to this part of the world, to Singapore specifically. Scenario 2, we have Mr. Zumba and his partner, who are senior bankers leaving the bank to set up a boutique fund platform to manage their own wealth and also a small circle of clients. What would your approach in advising them?
That's a very helpful approach, Ying. I think helps, like you said, make the conversation real. I will always start off with trying to understand where they see themselves in the long run. I'm a firm believer of beginning with the end in mind, and understanding where the client wants to be in the long run allows us to help map out the path for them to get there together. The concerns of a fund manager that's really trying to invest in a specific opportunity is quite different from a fund manager that's looking to grow and become the next KKR, TPG of the world. So once we get and understand the long-term aspirations, I will then ask them 3 questions. Firstly, I want to know where they plan to base their investment team. Secondly, I will want to know where they expect their investors to come from. And thirdly, I want to know where they are investing into and what sort of assets they're investing into. And all this will give us the factual matrix for us to be able to advise our clients effectively and come up with the most efficient structure for them going forward. And once we understand what they're trying to accomplish, the first question would be whether they're actually conducting fund management business. And there's obviously a technical approach to determine that. But for the layperson, I think really the key, it's a simple smell test. If you're managing monies for somebody, if you're providing non-discretionary investment advice to a person to make investment decisions, that all constitutes fund management in Singapore. And that's one thing that I think people may not be aware of. In Singapore specifically, even the provision of non-discretionary investment advice constitutes fund management. And on top of that, the other thing that people tend to be caught off guard is the individuals themselves who are providing the services also need to be licensed, or they need to rely on a suitable exemption.
Okay, thanks, Shawn. I really like your begin with an end in mind approach. So let's say Amazing Company, the first case, is setting up an office in Singapore just to market their services and products here in Singapore. Would they consider a regulated fund management activities?
The MAS has actually come out quite clearly to say that if they're just marketing marketing products in Singapore, that would not constitute fund management, so they wouldn't be granted a fund management license. That said, the marketing of funds in Singapore is still a regulated activity. Typically, that would fall within dealing in capital markets products. So they would still need some form of licensing. But it'll be quite uncommon for a fund manager to set up a full license outfit here just to market their own funds. It is much more common for them to work with a distributor here in Singapore who is already licensed in order to do that.
So in what situation could the fund manager rely on the exemption instead of applying for a full license?
Now that's a very good question, right? What we want to accomplish is to minimize the regulatory footprint required of our clients. And the 3 common exemptions out here in Singapore. The first one would be a related corporations exemption. So if a fund manager is just managing its own monies or its monies of a related corporation, and the related corporation doesn't take the money as part of an investment agreement, a fund manager like that would typically be able to rely on the related corporations exemption. Secondly is the immovable assets exemption. So a fund manager that's looking to invest into immovable assets on behalf of accredited and institutional investors, they will likely be able to rely on that exemption. And immovable assets, to be clear, refers to land, buildings, things that don't move basically. And then the third exemption that we would typically look at is if a fund manager is looking to invest into non-capital markets products on behalf of accredited or institutional investors. So capital markets products means anything that's securities, stocks, derivatives. If a fund manager, for example, is looking to invest directly into art pieces, that may be something that can rely on this exemption. I mean, the key thing to keep in mind is that all the exemptions come with its nuances. So we really need to work through with the fund manager how they plan to operate their business to determine whether the licensing exemption actually works for them.
So if exemption is not available for Amazing Co Limited and Mr. Zumba and his partner, what are the licensing options should they consider?
If they are unable to rely on the licensing exemptions, then we'll dive into the actual licensing options. And there are 3 licensing options here in Singapore. So firstly, they can be a retail licensed fund management company or retail LFMC. This gives them the ability to deal with retail investors. Retail investors means an investor that is neither accredited nor institutional. And that retail LFMC license comes with the highest obligations. And to be honest, that's quite rare in Singapore. I think more often than not, most managers would go with the second tier license, which is the AILFMC, which stands for a licensed fund management company that can only deal with accredited or institutional investors. That comes with slightly lower regulatory requirements and is more often than not sufficient for what most fund managers are looking to accomplish. And one tier below that is the venture capital fund management license. So if you recall the 3 questions we asked earlier on, right? If a fund manager says, actually, I really only am interested in making venture capital investments and I only want to act on behalf of accredited investors and institutional investors, then the VCFM license would make more sense. So that comes with an even lighter touch regime for fund managers looking to conduct these sort of activities.
Thank you, Shawn. For Amazing Co Limited, what are the tax incentives available to help them with their bottom line, Alan?
From a tax perspective, the key incentive that reinforces Singapore's position as a global fund management hub is definitely the Financial Sector Incentive - Fund Management Scheme, FSI-FM in short. This scheme offers a concessionary tax rate of 10% on income derived from qualifying fund management and investment advisory activities. As you can see, this is a huge reduction from the usual corporate tax of 17%. And generally, such qualified fund managers are licensed by the MAS, and they usually manage funds on behalf of institutional investors as well as accredited investors. To be eligible for this scheme, it is not just about ticking boxes. MAS places strong emphasis on substance. And that means the fund manager must perform core functions such as portfolio management or investment advisory right here locally in Singapore. They should ideally also conduct support services in Singapore locally, such as risk and management. But most importantly, the key decision making of the fund manager must take place in Singapore. With such a strong tax benefit, the FSI-FM scheme provides a strong attraction for fund managers to anchor their operations in Singapore.
Shawn, you mentioned earlier the 3 licensing options, namely retail licensed fund management companies or retail LFMC, which is for fund managers who manage funds from retail investors. We also have licensed fund manager for fund manager handle credited and institutional investor, which is the AILFMC. Lastly, we have venture capital fund managers for fund managers who's focusing investing into startup or companies that's less than 10 years. So could you share with us some of the important requirements that either the Amazing Co Limited or Mr. Zumba should meet for MAS to consider granting them the license?
That's an important consideration for fund managers to look at before they choose which license tier they go for. The short answer is that requirements are all set out in the MAS guidelines, and specifically the guidelines on licensing and conduct of business for fund management companies. I think for our session today, what I'll focus on would be 3 specific aspects that AILFMCs in particular think about and care about when they're looking to set up their operations here in Singapore and apply for the license. So first, the first set of considerations is the minimum staffing requirements. The second set of considerations is the financial capital requirements. And the third one would be the compliance requirements, how they actually go about complying if they do get licensed. So on the minimum staffing requirements, 4 things to look at. So you need to have a CEO based in Singapore. You need to have 2 directors, at least one of whom must be an executive director. Thirdly, you need to have at least 2 relevant professionals. And fourthly, you need to have 2 representatives. For the CEO, for the executive director, for the relevant professionals, all of them will need at least 5 years of relevant experience. And in respect of the CEO and the directors, because they are in a leadership position, they will also be expected to have managerial or supervisory experience. So it sounds like there's a lot of people that's needed, but the good thing is MAS has also made it clear that to the extent that there are synergies, one person can wear multiple hats, which makes sense, right? So you have a CEO that will also double up as an executive director, and he will also be an investment professional. And because he's an investment professional, he'll count towards the 2 appointed representatives requirement. In short, you need 2 investment professionals with the right experience, with the right supervisory managerial experience in order to start LFMC here in Singapore. Then on the financial capital requirements, there's 2 key ones that we look at. Firstly is the base capital requirement. So they need to have at least 250,000 Singapore dollars in the entity. And secondly, they need to have risk-based capital, at least 120% of the risk-based requirements. Thirdly, in terms of compliance requirements, that will depend on the amount of monies that a fund manager would manage. So if the AUM is 1 billion or more than 1 billion Singapore dollars, then they will be expected to have a dedicated compliance function. But if they don't, and the AUM is less than $1 billion Singapore dollars, then they can rely on outsourced compliance service providers. Like InCorp, right? I understand that you guys have a compliance service arm as well.
I thought here I should mention that InCorp provide back office operation support to a lot of startup fund manager who just begin their operation with a minimum staffing requirement. Back to you, Bob.
Thank you, Ying. So, Shawn, is there a way to test the market, an alternative pathway to kickstart the operations while they wait for MAS's approval, which I think would take up to 6 to 9 months? Am I right?
Yeah, that's right, Bob. For fund managers who would like to set up initial operations and test the market, it may not make sense to kick off the process by trying to apply for a license, take 6 to 9 months, and wait for it. And even if they do put in a license application, they may want to conduct business activities during the interim period. And one way to go about doing that, which we have increasingly seen in the market, is investment professionals working with fund managers that are already licensed. So the licensed fund managers will actually employ them as investment professionals, allow these investment professionals to benefit from the existing infrastructure and existing license to manage monies on behalf of third parties. I think one thing that the investment professionals looking to use this approach need to be aware of is that the licensed fund managers would typically expect to retain decision-making authority over investment decisions and divestment decisions. And that makes sense because they are the licensed entity, they have compliance requirements that they need to abide by. But for investment professionals, it can sometimes come as a shock. So I think it's important that everybody's on the same page as to how decisions will be made during this period before they enter into these sort of arrangements. And I mean, one thing to keep in mind is the licensed fund managers don't do it for free. They will be collecting fees as well. So that's a trade-off that an investment professional needs to consider before they take on such an arrangement.
Yeah, that's very practical insight that you share there, Shawn. So assume both Amazing Co Limited and Mr. Zumba and partners receive their licenses. What kind of oversight should they expect from MAS post-licensing? Could you share the common triggers for warnings or reprimands that you have observed from your clients?
Like you pointed out, getting the license is just the beginning. So it's important for them to get up to speed early on as to their compliance requirements and what they need to do. For the common issues that fund managers face, one of it is really fund managers not complying with the financial capital requirements, right? So that there's a very technical analysis as to how it's calculated, and working with compliance professionals like yourself is one way to mitigate that risk. The second category of triggers that bring on more MAS attention is failing to seek the right approvals before certain corporate actions. So one example of that is if more than 20% of an indirect interest in the fund manager is transferred, you technically need MAS's approval before that happens. Fund managers, that can happen for various reasons. Sometimes there's internal restructuring, especially in a large organization, and the right approvals from the MAS are not sought in time, then we will need to remediate the situation with the MAS thereafter. So it's really important for a fund manager to get up to speed early on. MAS is aware of the compliance costs, so they are also trying to make things easier. I would refer fund managers to the compliance toolkits issued by the MAS, both for LFMCs and for VCFMs, so the venture capital fund managers. I think I'll take this opportunity to just reiterate the point that MAS is not going around trying to find managers who are at fault and try and penalize them and punish them, right? MAS has a dual role of being both the regulator and the promoter of financial services here in Singapore. So they are going to ensure an appropriate balance. And in my experience, MAS is really an industry-friendly regulator. One particular experience that I'm aware of is there was a particular fund manager that had breached certain requirements, and at the end of the situation, when it was fully remedied, MAS issued a reminder. Rather than a reprimand, a warning, it issued a reminder. And I thought that was very interesting because you've seen a lot of the fit and proper disclosure requirements, right? And one of the requirements is, have you ever been reprimanded by an authority? And to me, MAS specifically couched it as a reminder, so it didn't trigger that requirement going forward because, if going forward for the entity, it needs to disclose that it's been reprimanded before, it's not going to be easy for them to conduct business in the future. So MAS is understanding to fund managers who are trying their best to comply. That I want to ensure is make sure is the key takeaway for our audience here today.
Thank you, Shawn. Thank you for sharing your insights. So now we move on to fund structures. So for Shawn, how do you help your clients structure their funds?
Thanks, Bob. When we structure the funds, the goal is really to create a structure that at the end of the day will be tax efficient, legal, regulatory, administratively efficient, and also familiar to investors. Because our goal is to raise as much money as quickly as possible so that fund managers can get into the business of investing the money and making money for their clients and themselves. So there are really three sets of considerations that we look at. First is the tax considerations. And that tends to be the most important set of considerations. From an investor perspective, every $1 less in tax that's paid is $1 additional return for the investor. So that is a very strong driver for how a fund is structured. One example of that would be investments into Australian real estate. So there are very specific tax requirements in order to benefit from the tax incentives there. So it usually ends up with quite complex structures in order to be able to benefit from that. I think complex to say the least. Alan knows how many squares and triangles the structure charts involve. Then the second set of considerations would really be the legal, regulatory, administrative considerations. So like we've been discussing earlier, the goal really is to minimize the regulatory footprint and to make things as efficient as possible, right? So one example of an outcome that arguably is not the most simple, at least from a contractual perspective, but from a fundraising perspective may be helpful, is if a fund manager says, I'm actually actively going to target investors in the European Union, we may then actually require a structure that is based in the EU in order to benefit from the marketing passport under the AIFMD regime. So that's the Alternative Investment Fund Managers Directive regime. So that's, again, another example of how understanding, going back to the original three questions, allows us to help guide our clients to the right outcome. And then the third set of considerations will be investor familiarity. So we want to ensure that our clients get a fund structure that is almost a no-brainer to invest into. So the last thing you want is to come up with a brand new vehicle that investors struggle to understand and they spend more time in the meeting with our fund manager clients. They spend more time trying to figure out the structure rather than actually focusing on the things that matter, which is what the team is capable of, what they've done before, and investment targets, etc. So those are the three considerations that we'll look at when we help determine the fund structure with both the client and the tax professionals.
Shawn mentioned about tax consideration as an important factors when structuring a fund, and we don't have time to talk about complex tax planning today. But let's circle back to our two clients there, Amazing Co Limited and Mrs. Zumba. If they are setting up in Singapore, and how could their investors benefit from a fund level tax incentive? Alan, could you share with us the Section 13 series tax incentive scheme that is relevant for them?
Sure, Ying. Thanks for that. Just let me give you guys a quick rundown of the 4 key fund incentives that we have in Singapore, namely Section 13O, 13U, 13D, and the new 13OA. So starting with Section 13O, this is for Singapore resident funds, typically applied for VCCs. The fund will require at least 5 million AUM at the point of application. There is also a local business spending, what we call LBS. In short, it scales with the amount of AUM of the fund itself. That means the higher the AUM goes, the higher the LBS goes. Once the fund meets all the criterion, it will enjoy tax exemption on a list of specified income derived from designated investment. However, the catch of this scheme is that the 30-50 rule will apply. What is the 30-50 rule? Essentially, the 30-50 rule means that no more than 30% or 50% of the fund can be held by Singapore investors. Whether is it 30% or 50% will depend on the total number of investors in the fund. Clearly, MAS doesn't want too many Singapore investors to be involved in this scheme. Then we have the Section 13U. I'm sure you are quite familiar. It is the enhanced tier fund incentive that is way more flexible as it works for both onshore and offshore vehicles. Minimum AUM is 50 million and is also subject to the same tier-based LBS requirement as I mentioned earlier. What's powerful about Section 13U is that the 30-50 rule does not apply. This is unlike the rest of the fund incentives that I'm going to mention. You also have the Section 13D tax incentive that relates to Singapore offshore fund tax exemption. Again, the catch is on the 30-50 rule. This incentive is usually suitable for fund managers who want to base their investment team in Singapore but raise foreign capital. Last but not least, we have the Section 13OA incentive, which is essentially the same as Section 13O. It's just that it applies to Singapore domicile limited partnerships, as the GPLP structure is known for its contractual flexibility. So whether you are setting up a new onshore VCC, a Cayman fund, or a Singapore LP, there is a tax exemption scheme to support it. The key to picking the right fit will depend on various factors such as the amount of AUM, the investor's base, as well as the location of the investments.
Alan, you mentioned tax exemption is for specified income derived from designated investment. Could you give us some examples?
Sure. I think this list of specified income and designated investments that everyone has been talking about, it actually covers a wide range of securities, stocks, bonds, treasury bills, foreign currency, bank deposit, derivatives. Everything that you name it is almost there. But one key thing to remember is that it must not involve Singapore real estate. That is specifically excluded from the list. And that is something that fund managers really need to watch out for.
So, Shawn, our Venture Capital Company VCC framework was introduced in Singapore in 2020. And before that, there are other fund vehicles available, such as private limited partnerships, and some fund managers are using offshore structures. So, for Amazing Co-Limited and Zumba and Company, how would you advise them in regards to their fund structuring?
Thanks, Ying. And you're spot on that there are really 4 key Singapore vehicles that fund managers would consider, and also that fund managers based in Singapore can manage vehicles that are domiciled overseas. So it is actually very common for fund managers to manage a Cayman exempted limited partnership, for example. But coming back to our 2 clients, if they are keen to set up a fund structure in Singapore, the 2 typical options nowadays would be the limited partnerships and the VCC, the variable capital companies. In short, I would say it is much more common for a closed-ended fund to be structured as a limited partnership and for an open-ended fund to be structured as a VCC. Closed-ended fund means a fund with a fixed term, with a fixed fundraising period. Investors cannot withdraw their investments during the term of the fund. As opposed to an open-ended fund. So an open-ended fund typically has an unlimited term and investors can subscribe and redeem interest throughout the fund term. So open-ended fund, VCCs, closed-ended fund, limited partnerships. If we compare the 2, in general, the limited partnership is a lot more flexible contractually, as Alan alluded to earlier, as opposed to a variable capital company, which is in essence still a company. It's just that the capital requirements have been relaxed significantly. But because it's still a company, certain provisions in the Companies Act still applies. You're going to still have to issue shares, and you have to comply with a lot of the requirements expected of companies in general. The other 2 options, which are sort of off the trodden path now, will be unit trusts and private limited companies. So unit trusts, I think that is a much more common vehicle for retail offered funds. So retail offered collective investment schemes, they would be much more likely to be structured as a unit trust. I've actually have the experience of setting up a private unit trust. So usually you do that, again, tax reasons. You may want to create a tax structure based in Singapore in order to benefit from certain tax exemption schemes overseas. And the private limited companies, they still exist, usually for legacy reasons. So if a fund manager has been around for a long time and they structured their initial funds as a private limited companies, all the documents are already in existence, it's very easy for them to just sort of dupe it out again. That's where you see the private limited companies come into play. But otherwise, for a startup manager, for a manager looking to establish itself, it's quite unlikely they will go with that option. It comes with a lot of the Companies Act requirements, which makes it hard for it to operate as a fund.
Thank you, Shawn. So thank you for submitting your questions. We have time for one question. So this question comes from Jonathan Lin, right? So this is a question to Shawn. So for first-time fund managers, what are the common qualities that you see in successful fund managers?
Thanks, Bob, and thanks, Jonathan, for the question. I've had the good fortune of working with a lot of first-time fund managers and helping to set up their business from the early stage and see them grow. And the 5 qualities that I noticed in successful first-time fund managers are 5 characteristics, right? So number 1, and I use the acronym S.P.A.C.S, S-P-A.C.S. For number 1 is strategy. Number 2 is pedigree. Number 3 is anchor investor. Number 4 is charisma. And number 5 is service providers, having the right people on the team. So I'll go through them point by point. For the right strategy, number 1, typically successful first-time fund managers adopt a niche strategy, something that they is not out there in the market yet, something that they have a right to win in. It's going to be very difficult if you set up shop and you say, I'm going to be an Asia Pacific focused private equity fund, right? Then what is your right to win against a KKR, a TPG based out here in Singapore? Secondly, pedigree. A fund manager with a good track record will always find it easier to raise money. The successful first-time managers tend to have that strong track record coming from the right shops previously in order to come out and set up their own business. all the right relationships that they've nurtured over the years. Thirdly is anchor investor. You cannot underestimate the value of having a strong anchor investor who is willing to, back that 10, 20, 30% in the fund, and signals to other investors that this first-time fund manager is to be trusted, right? Makes life so much easier for a first-time fund manager that has a strong anchor investor. And, charisma. At the end of the day, fundraising is a bit of a marketing and sales exercise. So fund managers who are able to show up and convince fund investors tend to do well when on the road doing fundraising. And lastly, service providers, right? I think it's important to, and I think through this session here today, everybody realizes that it takes a team to successfully set up a fund manager and a fund. And having the right team on board will help you and help the fund manager get things done, number one. And number two, really focus on the things that matter, right? Because we've done it multiple times. We've had like I shared, we've had good fortune of working with multiple first-time fund managers. Bringing the attention and the energy to the things that really count will help them succeed and get to where they want to go. I mean, one bonus point I would add, I think, for a first-time fund manager, one reminder, notwithstanding you're a first-time fund manager, notwithstanding that it's the first time you're doing it, I think trust yourself and know your worth. I've worked with first-time fund managers that try to give a lot of discounts in order to bring in the fund management, bring in the AUM, right? And what I realized quite quickly is that, firstly, it may not be a viable business model for the fund manager. And secondly, if you know where you stand, you know what your capabilities are, and you trust in them, trust yourself to charge a market rate, right? Charge above market rate if you believe and can justify that you are in fact above market. And I catch up with my clients regularly, and I had it was a very touching moment when one of the fund managers said, actually, Shawn, you know what was the best advice you gave me? Hold the management fee at 2% rather than give a discount. And I said, I mean, otherwise the numbers wouldn't work, right? And she was like, yes, exactly. And I think more importantly, it set the tone for fundraising going forward for their future funds as well. And that's I think what a good team can bring to the table for fund managers.
Shawn, this is a question for you. So do you think fund structuring decisions should be driven by tax efficiency or familiarity?
I think both tax considerations and investor familiarity considerations go hand in hand. It's very common for something that is already tax efficient to be familiar to investors. But if push comes to shove and there's a new tax incentive scheme, I think tax considerations do trump investor familiarity considerations. Like we discussed earlier, every tax dollar that is tax payment that's reduced is an additional return to the investor. So investors can get comfortable with more complicated structures if required.
Another last final question. What's the biggest challenge you face in setting up a fund, regulatory tax, or even fundraising?
I think the most exciting and challenging part about structuring a fund is really to balance all the different considerations. So legal may require something, tax may require something else, and investors may be familiar with something completely different. How do we then bring all the considerations together and come up with a solution that actually works for the client, the fund manager client, for the investors, and for all the service providers, because everybody is looking out after one specific area? That is the most challenging, but also the most exciting part of my work.
Thank you, Shawn, and thank you to the audience as well for staying with us and watching us live. So in conclusion, in wealth structuring, it's not just about where your money grows. It's about where it's compliant and also sustainable. So understanding the regulatory and tax landscape isn't just a checkbox. It's a competitive edge. Thank you for watching. If you have any questions about building your fund platform in Singapore, please contact InCorp Singapore. Thank you.